Hello everyone, thank you for joining me. I'm going to go ahead and get my screen shared here. Let's see. There we go. And I'm going to start talking about mutual funds from chapter 13. So there's lots of good information about mutual funds in here, and if you have not already read the email or gone into course content under Blackboard to look at your investment project information, make sure that you do that because it is super important that you get a start on that. The investment project is not bad at all. It is actually a great thing, a great experience that you can have to learn about investing stocks. However, it's important that you get started on that right away so that you can go ahead and have it going and not start falling behind on that project. So I just wanted to throw that little plug in there. So make sure you go in Blackboard under course content, and then you'll find the investment project information, and there's a video and all that great stuff on there. So make sure you do that. Okay, so today we are going to talk about mutual funds. So this is chapter 13. So first of all, a mutual fund is a fund that brings together the money of many investors to invest in a variety of securities. So this is not where you are investing in a single stock. So I'm going to invest in Amazon, or I might invest in a few different stocks, or as we'll do in the investment project, invest in 15 different companies. This is different. You're going to have someone actually manage your investment for you, and they are putting your money and lots of other investors' money together in order to make a big investment into several different securities. So the reason that investors purchase mutual funds is, one, because it is professionally managed. It's hands-off. I don't have to sit there and stress out about my investments. I don't have to say, oh man, how is Apple stock doing today? I want to make sure I don't lose money. No, we can be hands-off. We have to pay some fees, but we can be hands-off and have someone else professionally manage our funds. And also they diversify our funds whenever we invest in mutual funds. So they're not putting all of our money into one or two companies. It's going to be spread out over lots of different companies, which is really going to help us out to minimize risk. So there are several different characteristics of funds that I want to tell you about. So the first one is a closed-end fund. This is only about 2% or less of all the mutual funds. But in these particular funds, the shares are only issued when the fund is first organized. It's kind of a first come, first served situation. So there are a certain number of shares. It's only issued in the beginning. The only way to get in on those shares in the future is to buy directly from another investor who's wanting to get rid of some of those shares. But otherwise, close-end is just first come, first served, basically. So most mutual funds are not that type, but that is about 2% or less of all the funds. Now, you may have heard of exchange-traded funds, ETFs. That's funds that invest in stocks or other securities contained in specific stock or security index. So this would be basically you're investing in the S&P 500 or maybe the Dow Jones. It's going to stay very similar to those indexes. So if the S&P 500 is doing well, then your stock most likely is going to reflect what the S&P 500 is doing. The benefit of this account, of this type of fund, is that it's kind of passive management. There's not somebody making as many big decisions as they are in the other funds, which means there are lower fees. So that is definitely an option to consider. That's, a lot of times hear it called an ETF. It's an exchange traded fund. And the last one is an open-ended fund. So this is where the shares are being issued and redeemed by the investment company at the request of the investors. In other words, there's lots of transactions happening here. This is the typical fund that people are investing in. It's not just a one-time first come, first serve. It is a situation where they are allowing lots of transaction, lots of these shares to be purchased. All right, so this formula is going to look very similar to one you saw in chapter 12, but this one is just talking about the specific funds. So it's the net asset value formula. So you have your fund assets minus your fund liabilities divided by the total number of outstanding shares. So again, this looks a lot like a formula we used in the last chapter, but this is our net asset value formula. All right, so for mutual funds, since they are professionally managed, there are different costs. There's a different way to go about each of these costs. So the first one is load funds. So these are mutual funds that the investor pays a commission every time they purchase the shares. So they are buying the shares and paying commission up front. It's usually between 3 and 5% of a fee for these funds. We're going to look at an example of these type funds in just a minute. There are also no load funds, which for the most part don't have any fees. So that can definitely be something to look for. Make sure you read all the fine print on those. I'll mention that again in a minute. And then there are contingent deferred sales loads. So that is where you pay between 1 and 5% charge whenever you actually sell the mutual fund. So the difference here with the load fund is you're hoping that that money you put in and pay your percentage on is going to be a smaller number than the money you take out and pay the percentage on, because the whole idea is for the value to increase. So that's something to consider when you see these different types of funds and you're trying to make a decision. So I told you we'd see an example. This is similar to a homework example for the load fund. This is where you are paying up front. You're paying a fee when you purchase the fund. So in this situation, you're investing $10,000 and they charge a 4.75% sales load. So what that means is you're going to take $10,000 times 4.75%. That would tell us that our fee up front is $475. So that means our $10,000 investment, only $9,525 of it will actually be invested into the fund, because the other $475 was taken out as a fee. Okay, an example of the opposite type of fund, the contingent deferred sales load, is you are withdrawing $6,000 from a share, from this B share mutual fund, and you have to pay 5% fee on withdrawals within the first year. So you're withdrawing this in the first year. So when you say $6,000 times 5%, we're going to have to pay $300 for withdrawing this money. So the actual money that we are getting out of this mutual fund when we do sell it, when we do withdraw the money, is going to be $5,700, because we had to pay a $300 fee. So our $6,000 minus the $300 fee is going to be $5,700. All right, a certain type of fee that I want to discuss with you is a 12B1 fee. So these are a fee that the investment company is going to charge to offset their advertising and marketing costs. So this can only be up to 1% a year, but they can charge it every year. So they're charging you to advertise this mutual fund to you. So in other words, just like when you see Honey Nut Cheerios on a commercial and it makes you want to go out and buy Honey Nut Cheerios, you want to reduce your cholesterol or whatever reason because that cute little bee is selling it to you. The price of Honey Nut Cheerios is more expensive than the off-brand Honey-O's because they have charged you for that advertising. So Same thing with mutual funds. They have this 12B1 fee that is charging you for their advertising and marketing. Now, they can actually charge this on a no-load fund up to 0.52%, so about 0.5%, and they can still call it a no-load fund for that reason. So you have to look at the little fine print to see if you're being charged fees even though it's a no-load fund. Since these are typically charged annually, they can really add up. So there's an example, let's see, on page 427 about how these expenses, these little fees, if they're charged annually, can really add up. So I would strongly suggest you look at page 427. It shows you if you invested $10,000 into 2 different funds over 20 years, and one of them charged 1.5% interest every year, and the other one charged 0.5%, basically at the end of 20 years, you would have about $60,000 in one of the accounts, the one that had 0.5% interest. So your $10,000 was turned into $60,000. That's awesome. That's why we should invest early. The other one that we invested the same amount in, but it had a 1.5% annual fee, only grew to $49,000. $49,000 is still a lot of money, but when you compare the two, that 0.5% on the one, so the 1% more on the second share really impacted the end result. So you have to consider that. So that's what we call the expense ratio. So that is what the companies charge for the fund's management and for any operating costs. There are a few different kinds of funds. We have mutual funds that are investing completely in stock or completely in bonds, which would be a little bit of a safer but maybe not grow as much investment. And also there's other funds, or there's funds that mix stocks and bonds. So those are different categories that you'll find for the mutual funds. So every single person is going to have a different financial portfolio. So a financial portfolio is all of those things that you have invested in and what your goals are, what your age is, how long you have to invest. All those things are going to be specific to you and your portfolio. So portfolio construction is the process of choosing the different types of stocks and bonds and funds and other types of investments. So you are trying to get a larger return. That's why you are investing in lots of different things, because you don't know for sure how each industry, how each investment is going to go. So you're reducing risk and hoping for the largest return is your goal in a portfolio. So we also have to consider the nation's economy, the world's economy. We have to consider interest rates, inflation rates, unemployment, all those things we need to think about when we are investing. You know, 2020 has definitely been a year of a very volatile market. It's ups and downs and very unpredictable, and we have to consider that when we are making investments. Definitely for retirement, the same thing. You need to ask yourself questions like, do I want to participate in a retirement account? Which mutual funds would I want to invest in for retirement? What stage of life am I in? At what point do I want to retire? How many years do I have before that time will come? Those are all important things to ask yourself about your goals for the future. When it comes to buying and selling mutual funds, there's a few things to consider here. So when you're buying these funds, think about managed funds. When they are managed, that means professional people are sitting behind the desk, they know what they're doing, and they are trying to make the very best decisions for you and your financial situation. Why is that? Is it because they want you to live happily ever after and they care so much about your well-being? Probably not. Probably because they get commission off of it, but still they are trying to choose the best investments to make you the most money so that ultimately they can get the most money, which is fine. That's how it works. However, we have to consider these index funds, these funds that would very closely model what's going on in different indexes like the S&P 500. And those actually usually outperform the managed funds. So it's important to make sure that you know who you're investing with, make sure you trust them, and to consider your different options before you choose a managed fund. I personally do have money in a managed fund. I want some of my money to be just hands off, and I want other people to make the decisions for me. But let me also mention, sometimes those commission fees are negotiable. So make sure you see, if you sit down with your financial advisor, financial planner, make sure you ask if there's any way to lower those fees, because like I talked about on the page 427 example, those fees can really, really impact how much you actually make in your investment over a long period of time. A business prospectus. So you can read all about this on page 439, but basically it is when you are considering investing in a company, it is something that the company can give you about the funds or about a specific stock to tell you all about the company, all about their risk tolerance, all about their financial situation, all about their past finances. You can compare all of that. Lots of fantastic information. They recommend that you read all of it so that you can really make an informed decision about your investment. So that's what a business prospectus is. And again, you can read more about it on page 439 if you want all the details, but mainly it's just all the information on the investment that you're considering. All right, so there are taxes on mutual funds. So first of all, you'll get a statement at the end of the year telling you how much you got in dividends, and those are taxed as income. Then if you have any capital gain distributions or capital gain from selling your stock, then those are going to be recognized as either long-term or short-term capital gains. And there are ways to defer that tax income that you have to pay taxes on. There's possibilities of investing it in different retirement accounts and reinvesting it in different ways to defer the tax payment on those. And then the turnover ratio, it measures the percentage of the fund's holdings that have changed during a 12-month period. So how much has my fund changed? This turnover ratio can show you that. My final slide I'm going to share with you today is actually my own personal snapshot of a mutual fund that is managed by Edward Jones. So I just want to give you a little real world glimpse at what a mutual fund looks like. So if you look over on your left, it says description. That lists out all kinds of different shares that the professional team has decided to invest in. It gives you the symbol because every single company has their own 2 or 3 letter symbol on the stock exchange. It's just like an abbreviation or something similar to that. And then it tells you which asset category. You'll recognize these. We've talked about growth and income accounts. So growth are the higher risk that are hopefully going to give you more growth on your investment. Income is less risky, but it can give you a very stable income. And then growth and income, as you see on some of them, are a little mixture of both. So maybe a little mid risk there. And then on the final column to the right, it tells me how many shares of each stock that I have in my portfolio. So I just thought it might be helpful to take a little glimpse of this and see what an actual mutual fund looks like. So hopefully all of this information will help you, and you have learned about mutual funds today. Please let me know what questions you have, and please be sure to complete the homework by Sunday. That does count as your attendance grade. I hope you all have an absolutely fantastic weekend, and please reach out with questions.